order. So I'll start with journey and expertise, and then get
Mhm.
into role. We'll get into actuaries and economists, and then we'll get into kind of the current economic environment
Yeah,
before we open it up for question and answers.
cool. I'll do the normal intro. I'll introduce Coffee Conversations and Thomas, and then I'll throw it over to you all to get started.
Fantastic.
Okay. We start letting people in now and then start maybe like 103.
That's fine.
Okay. Good afternoon, everyone. We'll be getting started in just a few minutes.
See you, man.
All right. Good afternoon, everyone. Welcome to our second installment of Coffee Conversations here. I am Parker Williams. I'm the Director of Programs for IABA. To those returning, thank you for doing so. And for those who it's their first time at a Coffee Conversations, thank you for joining us. This is a program where to offer our members that gives them some insight into the different aspects of business and allows them to gain the knowledge they need to start moving up or moving in the direction they want in their organization. So today's Coffee Conversations guest is Thomas Holzheu. He's the Chief Economist Americas at Swiss Re. He leads economic forecasting and insurance market research across the region, supporting strategic planning and business development. Thomas is a frequent speaker and author on topics ranging from catastrophe trends to protection gaps and the role of insurance in financial markets. He also supports the Swiss Re's renowned Sigma research series. So I'm going to hand it over to Nana and Thomas to get us started. So thank you all for being here.
Yeah, thank you, Parker and Thomas. We're really excited to have you in this coffee conversations in our second installment here. Um, we like to get started by just getting to know our guest a little bit and understanding kind of your journey to where you are in your particular discipline and kind of in the insurance industry. So, if you could kind of start by just describing how you chose economics, what was compelling to you about that field, and then your journey into the insurance industry, that would be kind of a great foundation for us here.
Yeah, thank you, Nana, and thanks, Parker, for the introduction. I'm very happy to be here in this crowd and share some insights from, I guess, a bit of a different discipline, but one that is quite frequently and quite close in terms of being very numbers driven and very brainy in nature. So my interest in economics. So I came to the insurance industry right from university. I was interested at school in a broad range of areas, and probably was as close as being a chemist or an engineer than being an economist, but kind of a STEM similarity or commonality in these areas of interest. And in the end, it was my father was an economist, and I was just intrigued. It was always interesting. Dinner conversations was a natural lead-in, and so I did really when I studied at university in Munich. I fell right in love with the subject, and so was a good fit in that respect. Got to my first and current employer, Swiss Re, through a summer internship. And that was that I carried on for a couple of semesters, and then I graduated. It turned into an offer in a entry level position in a kind of a graduate program that the company had. Then I could do my PhD in parallel to that job, and so that was a very untargeted and unplanned, slow morphing in from a subject that I love very much into getting into insurance industry. There was clearly never a plan of doing so. But that's the not very. I think it's in a way it's speaking to a lot of people in the industry. It's quite a usual phenomenon that the random interaction with the industry. It's not very well known, but then when once you make the connection, it's a good fit, and that's where I am. So
and I think that's a good kind of segue into. Oh, can you hear me?
Yes.
Okay. I was going to say, I think that's a good segue into our next section. I'm sure there's some of us who've interacted with the economists in our organization, but it's not a common interaction for, most of us doing actuarial work on a daily basis. And so at a high level, if you could kind of describe what the role of an economist in an insurance organization, or in your case, a reinsurance organization, really is, and what kind of the most significant value you feel like economists provide to insurance organizations, that would, I think, continue to kind of help us understand, how we should start to understand how we should be thinking about interacting with economists in our own organizations.
Maybe before I go to the current role, let me just step back and a little bit more on my venue. So when from an entry level position, I was working in a marketing market research environment. I was looking for what is a good what are jobs that you can do with this type of education and this type of interest. And so I was looking for did a job rotation into underwriting, and so I was spent a year in 3D underwriting, and I learned about the business, but it's not very. There was not a lot of application of economics, and it was very, in a way, it's disappointing for me as a personal experience, because when you are very excited about a subject and you spend a lot of time and invest in education, and then there was no direct application whatsoever. So that's started a bit of a journey of search for what else could I find. And so so that was a rotation in the same company in Munich. I looked then for went for a rotation to the headquarters in Zurich, and there it was. I went to the strategy department, and that got much closer in terms of where it was more quantitative, more strategic thinking, market analysis, competitive analysis, kind of more to my liking, and looked. That was a step, a search into finding a good fit. And then, as a part of that rotation, there was another step where then I spent some time in the economic research team, and there I found then the match that I really liked, and it just happened that the team then was expanding and setting up a hub in the US to analyze the biggest market for Swiss Re. And so I got on an international assignment, and so from Zurich I moved to New York, and then out of a 2-year assignment, I met my wife, and plans changed, and so kind of still in the same with the same background of random coincidences. But the sum of a couple of these random coincidences then brought me to the field of work that I really liked, and the country where a lot of the action is happening, and where economic research for an insurance company really matters. Right? So that's kind of the bit more of the. I touched a couple of areas where there was some connection, but not necessarily the very direct application for my time of education. But there are economists in underwriting. There are economists a lot in finance, in strategy teams, and so on. Now, to explain what I'm doing now in my role, so it's part of the economic research team. We are the larger team is called Swiss Re Institute, and we're a bunch of economists, and we support the planning process of the company, and we do that with macroeconomic and insurance market forecasting. We support client interactions, marketing support in various ways, where the same type of topics, the same issues, where we support client management teams or clients in addressing key issues, industry issues, and we use that in a consultative or in a marketing support way. And the third aspect, and that's strongly related, is we do this market research for publications, for thought leadership, and our publication series for Swiss Re that's public and well known is called Sigma, and that's on insurance economics. And we analyze market trends and with various areas, but we talk about nat cat loss trends, bring it into property insurance and reinsurance. There's life topics. We talk about casualty topics from time to time, and so on. So this is and these types of so we look at some of these key trends, and that this is also brought to clients in interactions in various fashions. So that's kind of the major role. So it is insurance, macroeconomic forecasting, helping to understand or plan around growth, very much inflation and interest rates. These key topics, key variables that are relevant. The inflation more on the P&C side, but then interest rates obviously of high relevance for all lines of business. What we do not do in our team, but there are other teams in Swiss Re that are some are adjacent or quite relevant, is there's a specialized NatCat research team that do the cat modeling, and then we also have a mortality research team that analyzes mortality trends.
That's
that answer.
That's really helpful. You said something a moment ago. It does. You said something a moment ago though about when you moved, to New York on your rotation here, that you were moving to a place where the action is, where insurance research really matters. I kind of wanted to revisit that and maybe go a little bit deeper into what you meant by that. So when you say you were moving to sort of a market where insurance research really matters or seemed to sort of be more influential, maybe help us understand a little bit what you're meaning by that.
Well, so the US is by far the largest risk pool in the world, and the largest insurance market, and particularly on the P&C side. So for example, we analyze catastrophe losses and how that drives property insurance, and if I recall this right, I think in last year, 80% of all insured losses came from the US. So it's so there's a lot of trends, a lot of data, and so that's one area where we see faster development. We see and then also we see with 50 different states, there's with quite different regulations, we see more natural experiments, as we would call them, where then also companies or regulators and governments are reacting in different ways. So you have slightly different setups, and you see different outcomes in insurance markets. Very much an issue, for example, if you talk about homeowners insurance. Florida and California, both highly exposed to catastrophe trends, and a lot of research goes into those, and a lot of research comes from US research units as well. But then you see a lot of market intervention there, regulatory nature, and so quite different outcomes. The US is the biggest liability risk producer of the world. The US liability regime is quite unique, and the total liability outcomes are an outlier worldwide in terms of frequency and severity, and they develop rapidly. So that's something, huge risk pool. Probably 50% of all liability risks worldwide are, or more than maybe 60 rather, if you talk about commercial liability, would originate from the US, has created enormous volatility in results by simply getting it wrong. That goes to the actuaries, getting it wrong. So. Not the economists. No, the economists obviously didn't predict that either. But so social inflation, key huge area of interest, and it comes in waves, right? So this is there was a social inflation wave in the around the 2000s, and there's obviously liability crisis in the late 80s, in the mid 80s, and so on. So we see the development of the cat bonds, or the alternative capital market. Yeah, that's a US capital market phenomenon. It kind of moved offshore for the location of the carriers, but in the end, these are US risks mostly. and US clients. And yeah, by all means, Bermuda is 2 hours away from New York. So that's just some extension of that North American market. So this is yeah, you see here some of these big developments and areas of research, and that's and it really is tied to the bottom line of the company. So it's the size of the risk pool. It's related to the size of the surprises. So if you think about, again, the liability business, the asbestos crisis, and which really challenged the industry. We some of the biggest nat cat losses. Hurricane Andrew shook the entire industry in 1992. The World Trade Center loss shook the industry globally. Hurricane Katrina, biggest insured loss so far. And so now we have the wildfires. I mean, it's really it keeps going, and so keeps producing surprises. But then also we had during the COVID, we had economic inflation shocks due to supply chain issues, and we had construction costs go up by 40% in 2 years. That put the property insurance, homeowners and particularly homeowners, but also commercial, under pressure, and caused significant underwriting losses. Industry reacted to it, and now we hear a lot of issues of following the increase of premium rates. Now affordability of issue of homeowners affordability, and insurance being part of it is becoming a political issue, and we see that a lot discussed in the media. So just highlighting a couple of these areas where I was involved in the last few couple of years, and that show this interaction of some of the macro drivers or other exogenous drivers like catastrophe losses, but then also COVID and excess mortality coming out of that, but clearly challenging the industry, profitability, supply demand imbalances, and trying to find ways to forecast, support the planning, how to come out of it, or how the industry will grow, and how it will how certain markets will develop compared to others. Right. So for a global company, it's always
as
go ahead.
Oh, go ahead.
I was just wanted to finish the thought that as a global company, your capital allocation is a key question, right? So you can play in, you can try to shift strategic focus on certain lines of business and certain markets geographically, and trying to, and a forecast of these of the growth potential or the growth of these risk pools, of these profit pools, is key for that, and that's one of the main tasks.
Yeah, as I'm listening to you kind of talk about the various reasons that economics research is interesting or useful to insurance companies, I mean, a lot of it sounds like it's supporting, for lack of better terms, where a company might move their chess pieces. But even the piece about the United States market sort of providing for these natural experiments in the insurance industry because of the fact that you've got this distributed, regulatory framework with each of the states, in sort of treating various issues differently. But then you've also got different geographies, so different sort of at least on the PNC side, you have these different risk issues that might emerge, and that combination of things producing different outcomes is really interesting to me, especially for companies that might have interests globally that can say, okay, we saw this combination of things in the United States. This is how this might play out in a similar regulatory environment in another place, even if there's, lags in development and things like that. So this is definitely making me think
Yeah.
even a little bit differently about how I might think about an economist's approach to the insurance industry. Um, I guess sort of continuing on that as we think about um, our work as actuaries, as we were preparing for this call, you pointed out, some of the similarities and differences in terms of, how actuaries and economists think about various aspects of their work from a quantitative perspective, right? Views on time, approaches to modeling, um, how we think about correlation and causation. Could you touch on your thoughts around similarities in the ways that our disciplines are practiced? And I know there's going to be some obvious differences between the PNCs, between the PNC area and the life area, but
Yeah. Yeah.
maybe similarities, some differences in things that you think our disciplines might have to learn from each other.
Sure. Yeah. I'll give it a try, and you can remind me of our conversation maybe if I go in the wrong direction. So starting with the similarity, it's obvious. Yeah, it's extremely quantitative. So this is it's very clear. It's fact driven. Um, some of the key challenges are the same. Yeah, it is you have separating signal from noise. It is trying to distinguish between correlation and causation, and some. In the end, a lot of the basic statistical training is the same, right? This is it goes back 200 years as a science, and it's pretty well established in some areas. Of course, there's clearly modern new development at the margin. I think one of the maybe that's just my view. I mean, I did not work, or I do not work as an actuary, so I may just have, that's just my perception. But um, uh, my particularly looking at PNC actual work, I see this is it's very much driven by existing data, the very strong emphasis on the on data, on historic experience, and trying um, to analyze and detrend, or try to get yeah, separate out noise, and then but this being the main source for the signal. For in economics, I mean, data is also is always should be the main source of the signal. It's a little bit maybe it's often more of a very long term view of data, and of some of the driving forces. If I think, for example, business cycles, a business cycle is somewhere around 10 years. So if you want to analyze business cycles, if you have 10 years of data, you have basically one observation. You don't have 10 observations. If you talk about annual data, that's kind of a very different way of thinking. So you need to have 50, 70 years of data to have your 5, 7 business cycles, and to start to getting to a point where you can find similarities, or try to discover the patterns. A lot of economics theories are rooted in cyclicality, or a lot of economic phenomena are rooted in cyclicality, and variables that are mean reverting, and where trends that are actually not trends but are mean reverting, and in some of the modeling assumptions. So I think that's something. Um, uh, I think that's that's a bit of a different view of the world. Yeah, that we um, there's often you may have a growth in a variable that keeps going for a couple of years with an extreme value, be that growth, be that interest rate, be that something like that. And but if you then look at this larger context, and if you look at some underlying models, then it looks like a stretch, and saying, okay, this is an outlier. There are forces that will bring it back, and then hopefully eventually this will happen. Forecast errors can carry on for many years sometimes. And so this is we just went pre-COVID through an episode with 10, 12 years of interest rates being below our forecast systematically. I think one approach typical for economists, at least, should be, and I can't really judge whether how much that's part of the practice in actual work, but it is that when you get to your data analysis, that you do not start out. And actually, that is referring to a bit of a challenge with going forward and with combination with AI. Um, when we when we try to do data analysis, is we don't just go into the data and look for the best correlations, the best fit of models, but there's often a multitude of possible models that would explain a relationship, a causational relationship, or what is driving interest rates, and then we try to formulate this as hypothesis up front, and then we try to grab the data and try to find the functional form, and kind of try not to make it completely data driven, but to have somehow the logic beforehand, before we start fitting the data, because that's otherwise there's often otherwise there's the risk that you just you build your explanations to fit the data, and there are often conflicting models, but you usually in a reality environment, you should have an a priori assumption of what's going on, and and more often than not, this should be the right direction. So we'll bit wary of methodologies where you have some programs automatically maximizing, optimizing some functional fit, and then you have a really good explanation of the data, but the forecasting properties are very poor. So the out of sample, the testing, or the actual forecasting didn't go that way. And this is particularly important at a time like I said, the last 5 years, when you have a lot of big events, big shocks that are not typical, right? So you have a COVID shock, you have a war in Europe, you have inflation crisis shock that's a different one, or we haven't really had inflation shock in many decades. So all the data fitting exercises, or everything that is just looking at, let's say, 20 years of data and averaging or extrapolating, all these models would have done miserably. So going back and to the drawing board, and and just thinking in big terms. What is happening here? What are the big forces? What's supply demand? What do we see going on? And then build the data work around those key assumptions. And yeah, that's kind of the some of the description. I'm not sure how much that is now a contradiction or or different to the actual practice, but it's kind of some of the key ways of economists how we think when we approach the data.
No, I mean, I think that makes quite a bit of sense as we sort of see the emergence of analytics and how sort of AI tools are sort of enhancing our ability to do analytics. Um, there's still something to be said for what are your observations and what are the hypotheses that your observations inform, and then how do you sort of go about your forecasting work that way. So I think for me that the message I'm kind of taking away is like, how do you marry these things in a way that makes sense and still allow you to sort of respond to reality and think about reality, um, sort of in a big picture view rather than sort of immediately being sucked into the data, and losing your ability to sort of use the observations to, build your forecast and build your work that way. So, and I'm no quantitative expert, but I'm sort of thinking about this in the abstract. So I think
Yeah.
that's a really useful message for us.
Yeah, I
Go
mean,
ahead.
I think to follow up on that, I mean, there's not a there's no easy answer to that, right? So I mean, it's kind of the experience you gain over the years in dealing with situations, right? I mean, there is a quite typical reaction pattern is if you have a problem, if you have increased uncertainty, we ask for more data, right? So that's kind of that's a bit of a standard um, reactive pattern that I think everybody who deals with data and with forecasting where we fall into. But if the level of uncertainty becomes too high, then it just bogs you down. It doesn't really create a solution. And sometimes when you have a kind of a regime shift or a significant shock to the environment, then sometimes the simplicity and stepping back is and looking at the big picture and would be the better way of addressing the situation and coming up with some guidance. And so this is, and I think that's one of the maybe the takeaway from maybe the last 5 years when we really had some tail events and some external shocks to the system.
I appreciate that reflection. So I think now I kind of want to get us into what's probably on everybody's minds, sort of explaining and understanding this current economic environment that we're in. So we can sort of think about it as a timeline, largely sort of dictated by American electoral politics, if you will. Um, but there's real implications on that for the world, for consumers, for the industry. So maybe if you talk a little bit about your observations with that, and what are things that we need to be paying attention to as a profession and as insurance professionals.
Yeah, so this is obviously a very different way of doing politics, and it's a very different set of policy tools that we see now compared to whatever prior 30, 50, whatever years. And it's therefore difficult and different to analyze and assess. So the key, or the biggest driver of policy at the moment is obviously the tariffs. Then we have immigration. Then we have Doge and a lot of actions around the budget. And then we would have deregulation, and we would have Fed independence. These are kind of, I would say, the five main variables that we look at the moment. And the sequence is it's kind of a ranked order. So in terms of the magnitude, and the biggest lever at the moment are the tariffs. And the problem is that the application of the tariffs and tariffs in the way how the broad scope as they are laid out at the moment, the impact for the US is as we analyze it is that it has it's a taxation of US consumption, so it's inflationary, and it disrupts supply chains, and it decreases real income, and it creates uncertainty. So it will be negative for growth. So that's kind of the package. It's kind of deflation. It's stagflationary in nature. The key is to differentiate then the order of magnitude. We just started with the beginning of the year. The U.S. economy was doing quite well in 24, was strong, growing above trend, low unemployment. Disinflation was proceeding, maybe a bit slower than some were hoping, but clearly we were 1% off the central bank's target. And we remember we had peak in inflation was 9%. So came a long way. And just the last percent is the hardest. So with that, we saw a lot of announcements, unclarity about the magnitude, the intentions. So we started adjusting. We created scenarios, and I think that's the key to communicate here. How is this different? So instead of just having a base forecast that we baseline economic forecast that we update every quarter for the US, and usually this the baseline, then we have alternative scenarios, recession scenarios, with a certain probability attached to it. But the baseline has the biggest probability. So there's strong central tendency towards a baseline and the baseline numbers, and then there would be some alternative scenarios with lower probabilities. Now, if you get to either if you get closer to a recession, or if you have this a high, if you have shocks or uncertainty, then the probabilities of the alternative scenarios will start to increase, and that's kind of the key change in the way of doing business. Is that from starting in earlier this year, and with the new administration, and a lot of confusion around the intentions and the announcements, that we had to develop more alternative scenarios and shift more of the weights into those, which of course becomes kind of difficult for how do you translate this into the planning of a company, and how do you usually it's a single set of parameters that goes into all your costing and tools, and so for a lot of the inputs into underwriting, it's usually one dimensional, right? So you have one set of numbers, and not multiple parallel possible outcomes. For risk modeling and for strategic planning, companies obviously use alternative scenarios, and they then are either they're for planning purposes, or they indirectly will drive capital charges through volatility assumptions. Yeah, so, but that's what and shifting a little bit tack here. So one of the challenges that's typical for this type of job for the economists is that also is that in such in a time when uncertainty is increasing, and the nature of our deliverables to the executive board, to the executive team, changes also its nature a little bit, right? So it's not just the one set of numbers, but there is more uncertainty around it, and so it becomes quite a communications task or challenge to prepare the senior decision makers for this. So this is we're showing you this number, but this is the confidence around this is a very different one than we used to have for the prior 10 years or 20 or 50 years, right? So that's kind of just as a bit of a tangent. The role, we are not so much tied into the underwriting processes on a day-to-day operation, but more this planning support. So the numbers alone are only part of the job, of the deliverable. It's a communication and delivering compelling stories, and but then also communicating changes very quickly is key part of that job. But going back to where we are now, is so we have the trade war started, and it's stop and go. So we have even more scenarios now, and with different magnitudes or levels of escalation of a trade war, and we are basically shifting our forecasting then between these various possible scenarios, and at the moment we are shifting our view that this trade war, the way how it's playing out right now, is more likely than not will lead to a recession for the U.S. economy, based on the impacts, the significant disruptions on some key industries. Now, the other impact, so growth will go slow to, let's say, close to 1% average for the year, and this can imply and then 2 negative quarters, which will get us to a recession. Based on just the nature of the quarterly numbers, then we will have the momentum that came from last year will make it that we will have an average growth of 1%, even if the second half is negative and weak. So that will reduce demand, that will reduce income. So for personal lines insurance, commercial insurance, there will be some impacts. Some of that will come with a bit of a lag. The bigger impacts will be the inflationary nature of the tariffs, and that's because some industries are more targeted than others, and that's particularly motor. There are these 25% tariffs on car imports. That will drive up car prices. Less imports will drive up used car prices. We already see that in the data on the wholesale level. New car prices and car parts also being part of tariffs. So we will have, with some lag, more or less, depending on the various variables and times when tariffs are kicking in, you will have an increase in for motor claims costs, everything that's tied to the physical damage part, which is also will be also part of motor liability, the part of the damage done to the third party on their vehicles. So claims costs on motor are being pushed up by these tariffs, and the longer they're on, the more that will have an impact. Similar, there are tariffs on commodities, on steel and aluminum, and potentially on some other construction materials that will be relevant for construction costs and therefore for property. And this is a bit less dependent on imports as an industry than motor, but also an industry that will face potentially higher claims costs with a tariff scenario, unless they will be unwound very quickly, which is not our most likely view. So we do expect that there will be some negotiations, ultimately lower levels than what we see in the April 2nd announcements, but there will be a negative impact on prices for and driving up claims for motor and property insurance. For life, the impact will be indirect, whatever it will do to interest rates, and that's quite relevant, depending on whether there is a recession, which would pull down interest rates. If there is an inflation shock, this will prevent long-term interest rates and also policy rates from going down. So the degree of inflation will kind of limit the way the magnitude of interest rates going down. Yeah, but this is kind of the key impact for the life industry. Overall, there will not be direct impacts. There is no tariffs on services. At this point, there could be taxes on services, but it's not on the program. So the key impact is uncertainty, potential recession, inflationary pushes, particularly for motor and property lines.
Appreciate that, Thomas. I do want to get into a little bit of Q&A. I know we only have a few minutes for that. I see a question from Lisa in the chat regarding the reliance on retrospective data and trends. So given that reliance and now the recent frequency of the atypical shocks that we're seeing, such as a pandemic, war in Europe, trade war, is that reliance on retrospective data and trends, both for us as actuaries or for you all as economists, still an effective and relevant focus to understand how we forecast future economic environments? And if we can't rely on retrospective data and trends, what does become something that we can focus on to do so?
Yeah, that is not easy to answer. So I would say the reliance on data is the nature of the data that we look for is probably changing, right? So if you look at shocks, and they are atypical. So in a way, one way of dealing with it, and it obviously depends on what we're looking at. Yeah, but if we look at where shocks disrupting economic growth, for example, and we can look then, for example, at all the atypical shocks of the past. And so we look at how bad can it get, and what types of so we move out from looking data that looks similar. We look to shocks, basically. We look to the atypical, but then maybe there are patterns in the atypical, or at least some trying to find orders of magnitude for those, and maybe some very crude probabilities. Is this something that happens 1 in 10 years, 1 in 20 years, 1 in 100 years? And so trying to deal with that, and that's really what when we deal with these extreme scenarios. For example, one of the questions is now interest rates are at 4.3% right now, right? So they have been somewhere between 3 and 5% within the last 1.5 years. When it went up to 5%, it was created quite some stress somewhere in some financial markets. But that's kind of close to the central tendency, right? Because we have been there, we have seen those values in the last 18 months. What is an extreme scenario? When we worry about the Fed losing its independence. Where could interest rates go? And then we basically need to look, and will not find that exactly in the data pool or the history. But we can see what have interest rates done in the past, what were the variations, the fluctuations, then use some of these historic adverse scenarios, and take then the average of that, or take the range of those values. So that's kind of the very different confidence interval around statements like that. But these are extreme events or extreme scenarios, and then so you have little confidence. You also have low probabilities for those, but it helps to stress test if that's what it's used for. For example, your investment portfolio or your liability portfolio, and say what would be the bottom line impact for the company. Then you get a couple of 100 million or tens of millions or whatever how big your company is, and sees that does this fit in the risk appetite.
I'm going to try to fit one more question in here. We've got one more from John about using AI to help find trends. So is this something that you would either recommend doing, or something that you think can be done as we move into the future and as AI technologies advance?
I mean, yes. I mean, we will use AI, and we probably all do it already, right? So I think it's very clearly something. It just think of it as a research assistant, right? That's basically, maybe that's where we are at this point. The capabilities, and you wouldn't let the research assistant come up with the conclusions, but they can do a lot of legwork, and it's the same thing with AI. It can be very helpful in structuring unstructured data or collecting unstructured data. It can be helpful in identifying structured data that you didn't have the same access before, or in changing frequency transformation. A lot of areas where where it simply helps you and saves you time. I would not suggest to use AI for the heavy lifting, and that's coming up with hypotheses, or doing the heavy lifting of some modeling. Also, certainly when it comes to the programming part of modeling, if that's part of your job, then again, AI is obviously apparently one of the best. It's one of the best use cases, and just helping in cobbling together models. But the architecture of the model probably should still be coming from you, as you also will put your name under it, and you also probably have to explain it to someone. You have to explain the outcomes. And if you, it's for some simple tasks, a black box may be fine, but for if it matters, a black box is difficult because you will not be able to use it probably to the best extent. You will not be able to answer questions. You will probably be able to answer question about sensitivities. What would happen if things turn out in a different way? And if you don't know what's in the black box, you may not get the proper answer for it.
No, thank you, Thomas. I think we're probably out of time here, so I'll pass it back to Parker to close for us. But we really appreciate you sharing your insights and your experience with us, Thomas.
Yeah, absolutely. Thank you again, Thomas, for being here and being our guest. I'm sure everybody gained something insightful from what you said. Thank you all for being here. Make sure to check your emails in the next couple of days. Send out a survey just to get some feedback and try and make these as effective and as informative as possible. So, again, thank you guys for being here. Have a great rest of your day, and we will see you back in June for the next coffee conversations.
Thanks,
Thank
everyone.
you for having me.
Absolutely. Have a good evening, everyone.
Have a good day.